Well, hello everyone and welcome to Momentum channel. My name is Mo, and in this video, what I'm gonna do, I'm gonna provide the first edition of Momentum Blossom portfolio review series. For those of you who've been following my journey on Blossom app as well as on YouTube, you know that I've mentioned that I'll be going in to start these new series whereby I'll be reviewing the portfolio of fellow investors on Blossom who have shown interest and have kind of volunteered to have their portfolio reviewed. And I'm super excited to be going through the first episode of this series. And for this one, I've selected an investor from Blossom by the name of Dylan. Thank you so much, Dylan, for this opportunity. Without any further ado, let's get into reviewing your portfolio. All right, so here's a quick look at Dylan's portfolio on Blossom. The username that he has as well is listed here. Be sure to check him out and follow him as well on Blossom. First and foremost, taking a quick look at your stocks and the best performing based on all-time return. You do see that your best performing ones are Equitable Group, Algonquin, and Horizon Nasdaq ETF. In terms of the worst performing one, this final graph shows you the worst performing currently, which are not actually looking that bad. Is Enbridge is only down by 2.1%, and Vanguard FTSE Canadian Dividend down only by 1%. Your top performing ones though are doing quite good. You have several double-digit positive return on your portfolio, which is fantastic. I've then done a little bit more closer look into these specific holdings, and that's where the gist of this review is going to be focused on. So let me zoom in a little bit. Yes. First and foremost, let me start things off by listing things based on your highest exposure to the lowest exposure based on the money that you've invested. Your biggest holding currently is the Vanguard S&P 500 Index ETF. For those who may not be familiar, VFE gives investors an easy option to invest in the 500 largest companies in the US that are in the S&P 500 Index. It's in fact one of the holdings that I have in my portfolio. I believe it's one of my top 3 big holdings in my own portfolio, and I love it. Currently, you have about 21% of your funds invested in VFE. Your next big holding is VDY. And again, that's another area where we have a lot in common. I believe VDY is, again, one of my top 2 or top 3 holdings. It's a dividend-paying ETF, Vanguard FTSE Canadian High Dividend Yield Index ETF that is available in Canadian dollars, and you have about 20% of your funds invested in it. The beauty of VDY, and one of the things why I'm personally invested in it, is the fact that it does pay its dividend distributions on a monthly basis. So it's fantastic for those who want to collect dividend income on a monthly basis, then either use it or repurpose it even better, and repurpose and reinvest it to help have their portfolio continue to grow over time. Your third large holding is another ETF. I like what I'm seeing. So your top 3 holdings are indeed all of them are ETFs, and these top 3 holdings already account for close to that 60 or 50%, roughly around that 50% mark of your portfolio size. And the third one is HXQ, Nasdaq 100 Index ETF. Through this ETF, you're getting exposure to the Nasdaq 100 companies that are more growth oriented, and accounts for the top 100 of those companies here. And the list goes on. You see that your smaller holdings are the company in telecommunications. I've listed all the sectors here. The reason why I wanted to do that, I just wanted to take a look at how diversified your portfolio is. As you know, the stock market consists of a variety of different sectors. We have things like financials, energy, healthcare, industrials, consumer staples, consumer discretionary, utilities, materials, telecommunications, IT. You could look into the real estate investment trust and ETFs if you want to kind of consider ETFs as a basket of all the different stocks. For you, you are only currently exposed to these sectors that you point out here, mainly energy, the financials, telecommunications, and utilities. You also have exposure to the broader market and different sectors through the ETFs. That's the beauty of ETFs, because they themselves are exposed to multiple different market sectors. Indirectly, you get exposure to them. I'm noticing that 61% of your holdings currently is in ETFs. That's something, in my perspective, in my 2 cents, is something positive, because especially for many investors who are new to investing, ETFs is going to be a very easy way for you to invest in the market. Particularly the choices that you have are really good ones. You're looking into low cost index funds that gives you exposure to Canadian dividend paying stocks, S&P 500 through VFE, the US stocks, and NASDAQ 100 through HXQ. I really love the choices that you have there as well. You also do have some smaller exposure though to US dividend equity ETF, for example, to Schwab, and that's the only holdings that currently you have in US dollars. And you do have some exposure to income funds as well as an ETF. One question that I have for you is the Canoe EIT income fund. I know it has a very high yield. I'm not exactly sure about your age in this case, Dylan, but something for you to consider. My advice for investors who are new to investing, in particular if they are younger in age, is rather than really going for really high yields, it's probably not a bad idea if you have a more balanced approach. Have some exposure to dividend, but don't sacrifice your growth just by targeting companies or ETFs or funds that have very high yield. Because over the long term, when you look at it closely, you're a lot of times sacrificing your growth. And many times, many of these funds that quote unquote they have really high dividend yields or distribution yields, they end up actually suffering when it comes to their growth, and many times in fact have even negative growth in terms of their market price. Keep that in mind. Maybe reassess that for yourself. The other observation that I have is I'm going to quickly pinpoint something real quick for you here. You do need to notice some of these companies that I've listed in the white background, including Enbridge, Toronto Dominion Bank, Royal Bank of Canada, Manulife, Canadian Natural Resources, Pembina, Algonquin, Power Corporation of Canada, and TELUS. Let's quickly just add them up just to see how much of your portfolio is in those. Around 22%. All of these companies that I've highlighted here are indeed also available in VDY, the Vanguard FTSE Canadian High Dividend Yield Index ETF. In other words, just by you owning shares of VDY, you're already getting exposure to these companies. Now, I'm not necessarily saying that you have to right away go and decide and sell these ones. Some of them, in fact, are among some of your best performing stocks, and maybe there's a reason for you to get exposure to them, such as maybe you want to have higher exposure to some of these companies and you think that these are really well-performing companies, you have a strong conviction in them, and you believe that they are going to be there for the long term. Then in that case, it makes sense for you to have exposure separately. But if that's not the case, or you want to simplify your portfolio as a whole, it is kind of, in my perspective, a good practice if you try to limit your holdings. Right now, I do see you have a total of 19 different stocks. For me, I find it a tad bit too much. I personally, I'd like to limit it between maximum that 10 to 15 holdings. It just makes things easier for me to focus on things, a lot easier for doing research. And that was probably one of the reasons I'm leaning towards a lot more ETFs, because with ETFs, as long as they are high quality, low cost index funds that have a reputable past, and I know that their underlying funds are decent companies, I don't have to then really deal with a lot of research of listening to conference calls for these businesses, having to follow their news, or following the latest insider buys and sells and all of that jazz, or really going through a ton of balance sheets, reviewing the fundamentals of the companies, and so on and so forth. You might want to consider possibly over time trimming some of these holdings that I've pointed out here for you, and instead just possibly buy into shares of VDY. Or if you want to even make it broader and not just dividend paying Canadian companies, you could take a look at some ETFs out there, such as 𝗖𝐋𝐈𝐖, offered by BlackRock. It has a very low fee, and through 𝗖𝐋𝐈𝐖 you're getting virtually an exposure to the entire Canadian stock market, Toronto Stock Exchange. Would be a good one. It has a lower dividend yield, but that way you're not just limiting yourself to the 57 or 8 dividend paying companies that VDY gives you exposure to. Those would be some of my key observations. I like your overall exposure by sector, especially through ETFs, because you're getting a little higher exposure. But a few things that I highlight for you is your exposure to telecommunications and utilities is very low. You do seem to have higher exposure to energy and financials. As long as that's intentional and you're fully aware of it, that's fine. Just something for you to be aware of. If you wanted to have more diversification, you could either try to add companies that are from different market sectors, or continue to build or maintain your position in the ETFs, which are much more diversified for the most part. And many of these ones that you have here indeed have that level of diversification. They're not exactly equally weighted across sectors, but nonetheless, they are good choices for investors. Thank you so much again, Dylan, for the opportunity to review your portfolio. For those of you out there on YouTube or those investors who are on Blossom app, leave me a comment down below on YouTube or on Blossom, and let me know if you'd like your own portfolio to be reviewed here on Momentum Finance channel. I'm hoping that this video was beneficial not only for Dylan, but hopefully for other investors out there that would like to kind of take a second look at different portfolios out there and what type of lens we can apply when it comes to analyzing portfolios and what we can learn from them. Thank you so much for watching this video until the end. I hope to see you all next time.